Have you ever wondered about your credit score and how you can go about building good credit? That way you can save literally thousands of dollars on some of the biggest purchases you're going to make over the course of your life? Well, stay tuned because on this episode of MTT Finance, I'm going to be going over what is a credit score and how you can go about today building and creating a good credit score. That way you can save a lot of money over the course of your life. Credit scores are something that are really not that complicated, but if someone didn't teach you about them, then you might be in the dark as to what they are and how having good credit can benefit you so much. So first we need to look at what is a credit score. Oftentimes credit scores can be referred to as FICO scores, and it's a number given between 300 and 850. This number represents your risk to banks or other money lenders, and generally a higher number is better. So for example, if you're going to be buying a house or a car or taking out money for student loans, banks are generally going to take a look at your credit score along with your age and your salary, and then make a deduction of whether or not you are a good investment, someone to give their money to. A higher credit score typically means they're going to charge you less interest, less extra money that you're going to have to pay on top of the money they're letting you borrow. A lower credit score typically means that you're going to have to pay more interest on the money that they're letting you borrow. So yes, you do get punished by banks for having a lower credit score. That is why it is so important to learn how you can have a good credit score. Now, if you're wondering what your credit score is right now, you are able to check it online at annualcreditreport.com once a year for free. And there are some other sites like Credit Karma or myfico.com that you can also check it at for either a small fee or completely free of charge. So now that we've taken a look at what a credit score is and a little bit about what it does, now let's take a look at what affects your credit score. If you're looking to build good credit, it's very important you know what positively and negatively affects your credit score. So the largest portion of what affects your credit score, 35% of your credit score, is based on your payment history. This is based on whether or not you're reliable and on time with your payments each and every month. So if you're someone that's constantly on time with your payments every month for years on end, well, that's going to positively affect your credit score and it's going to boost your credit score. However, if you're someone that's late at making payments consistently, and sometimes even just one or two late payments can negatively affect your credit score, as payment history is the largest scoring for what constitutes your credit score. Moving down the list, 30% of your credit score is based on what's called your credit utilization. So I think the best way to describe this is to give an example. Say you have a credit card and your credit limit is $1,000, and that month you use $450 out of that $1,000 on your credit limit. Therefore, if we do some simple math, that means that you've used 45% of your credit utilization. Now, generally, it's better to have lower credit utilization, as the higher up you go to meeting that credit limit of $1,000, the more risk you pose to banks or to credit card companies at not being able to pay back that amount that you borrowed. So generally, something that's going to positively affect your credit score is to keep your credit utilization low. Don't go all the way to the max on using your credit cards each month, as that's going to negatively affect your credit score. Instead, ask your credit card companies for a higher credit limit, and that way if you do have to use more money, at least you're not going to be using over 50% of your credit utilization. Next on the list is that 15% of your credit score is based on the length of time that you've had available credit given to you. So if you're someone who has been with a credit card company for years on end, that longer length of time is going to more positively affect your credit score. As we've talked about with point number 1 here, the more time and the more payment history your credit card companies or banks have to look at your credit payment history is going to more positively affect your credit score. So if you just went out and opened up a credit card today, then that line of credit hasn't had any time for you to actually use it, and therefore it can't positively affect your credit score. Next up is that 10% of your credit score is based on whether or not you have any new credit. So if you do go out and open up a new credit card, that's potentially a risk to banks and to credit card companies, because that now poses the risk of you not paying back what you're borrowing to make purchases. So a new credit card or something like that, a new line of credit, is going to, at least in the beginning, negatively affect your credit score. However, if you're faithful with those payments on that new line of credit, that credit card, then that is going to positively affect your credit score. And then the last 10% of what your credit score is based on is what type of debt you have incurred. For example, if you're someone who has racked up a lot of credit card debt, that is going to more negatively affect your credit score rather than if you're someone who has a lot of student loan debt, because student loan debt is weighted a little bit differently, and it's not going to negatively affect your credit score as much as someone who racks up a lot of credit card debt. It's generally assumed that if someone takes out student loans, they're going to be in debt for a while. Whereas if someone uses their credit card to make a purchase, it's expected, so to speak, it's expected that they're going to pay back what they owe on that credit card. So 10% of your credit score is based off of what type of debt you have in your life. So now that we've taken a look at what affects your credit score, let's now take a deeper look at how your credit card affects you and how much you pay, which I'm guessing is why you're here in the first place watching this video. The bottom line is that a better credit score equals lower interest rates from the money you borrow from the bank. So when you go to pay for things like a house or a car or student loans, a better credit score is going to more positively affect you, and it's going to equal you having to pay less money over the course of time. So now let's look at an actual example of how having a good credit score could literally save you hundreds of thousands of dollars, and no, I'm not exaggerating on that. By the way, this example and the information I'm going to be providing is found in the book I Will Teach You to Be Rich by Ramit Sethi. If you're interested in that, I will leave a link in the description below. If that's something you want to check out, I'll leave the Amazon link down there so you can go take a look. So let's say, for example, that you are going to buy a house for $200,000 and you're going to be taking out a 30-year mortgage from the bank. Now, if your FICO score or your credit score is good, let's say 770, that means that you could get an interest rate of 4.2% interest on that 30-year mortgage. By the way, these examples in the book, I believe, are taken from a 2018 study and research on what the current interest rates were at that time for taking out mortgages. I know they might be a little bit different now, but the principle here still stands the same regardless of what the interest rate is. So on a 4.2 interest rate on a $200,000 loan, that means that the total amount you will have to pay the bank will be $355,420. That's around $155,420 just in the interest that you're going to be paying on this loan over the course of 30 years. And yes, that's a lot. Now let's take the same principle and apply it to a situation where you might have worse credit. You might have a bad credit score. Let's just say, for sake of example here, that you have a credit score of 630. That means you might be able to secure from the bank for the same $200,000 loan for the house an interest rate of 5.86. That now means that over the course of the life of your loan, you are going to be paying a total on the house of $425,585. That is a total of $225,585 just in the interest alone, which, if you remember, is more than what the cost of the house was. So as you can see, having a good or bad credit score really does affect how much you pay, and having a good credit score can literally save you thousands of dollars. No kidding. So now that we've gotten the doom and gloom out of the way of how a bad credit score can affect you, let's now take a look at some simple and easy steps that you can take starting today to build a good credit score and save yourself a lot of money. The first way that you can start building yourself a good credit score along with building good credit history is, of course, getting yourself a credit card. Now, I know that's a little controversial, but in order for banks to be able to see that you are a faithful customer with paying your loans and your monthly payments on time, is that they're going to need to look at your credit history. And the way to do that is to have a credit card that you're faithfully making purchases on. So be smart, pick a credit card that works for you, maybe something that even benefits you, like gives you extra cash back or travel points, and use it wisely. Shop smart with it. Don't go overboard. Don't put yourself in debt trying to build a good credit score. That's super counterintuitive. And once again, as I said earlier, try not to go over 45% credit utilization on your credit cards each month. The second thing you can do to make your credit score go up is to be faithful and make all your monthly payments on time. As I said earlier, that is one of the largest factors of what your credit score is based on. So if you're making your payments late or not paying them all off at the end of each month, then that is going to negatively affect your credit score. So do whatever you can to make those payments on time and complete them all at the end of every month. The third thing you can do to start building yourself good credit, and I wouldn't even say to prevent yourself from having bad credit, is to not open up too many lines of credit, such as having way too many credit cards that you can't handle. In my opinion, it's best to just have one or two that work with you, and that's way easier to manage than having 5, 6, 7, 8, because then you might put something on one credit card, forget about it, forget to make that payment, and then you're going to be charged interest that's going to reduce your credit score. So unless you're a credit card geek and a nerd and super on top of each one, it's best to just have one or two credit cards. That way you can more easily manage them and not fall into debt. The fourth thing you can do to prevent your credit score from going down, or even to make your credit score go up, is to not cancel any unused credit cards. Now I know this might sound counterintuitive to the third thing I just said, but let me explain. If you have, let's say, 2 or 3 credit cards, and on each one you have a $1,000 credit limit, if you were to cancel off one of those credit cards, usually when you cancel a credit card, sometimes that can have a little bit of a hit to your credit score, but it will also increase your credit utilization, because now you went from having $3,000 of credit available to only $2,000 of credit available. And as we talked earlier on credit utilization, that can negatively affect your credit score. So if you do have unused credit cards laying around, just make sure you're not putting balances on them and paying for things with them and then forgetting about it. That way you can still keep your credit limit high, which will then reduce your credit utilization, which will positively affect your credit score. And then the fifth thing you can do to positively affect your credit score and to prevent your credit score from going down, and that is to monitor your credit either on a monthly basis or just on some routine basis. That way you can see if there's any inaccuracies in the report. If you do find things that are in the credit report, such as spending you didn't do, or a missed payment that actually wasn't a missed payment, it just might have been the money didn't clear in time and so it showed up as a late fee or a charge, you should always dispute those with your credit card company or with the bank. That way your credit score is not negatively affected by those. In the book I mentioned earlier, I Will Teach You to Be Rich, the author does talk quite a bit on how you can actually talk to your credit card companies or to your bank to have fees waived, and how you can prevent those fees from them showing up on your credit report, which would negatively affect your credit score. So I highly suggest that book. If you haven't read it already, it's super down to earth, and it will definitely help you better understand personal finance, especially when it comes to credit scores and banks. But thank you so much for sticking around to the very end and watching this video. I know it was more of a heady video, and so I do appreciate if you give this video a like, a thumbs up, and subscribe to the channel if you haven't already. And if you know someone who's wondering about their credit score and what they can do to help improve it, well, be sure to share this video with them and talk about it with them in ways in which you have learned how you can improve your credit score. But until then, I will see you in the next video. Take care.